Hello, in this video I am going to talk about derivatives. This includes only 5 minutes content, okay? So you will get a basic idea about what derivative means, okay? Mark Rubinstein. Perhaps he was the earliest author to use the word derivative in finance. He used it in an article published in 1976 in the Journal of Economics. The word derivatives was originated in mathematics. It refers to a variable that has been derived from another variable. In science, a derivative is a substance made from another. Derivatives are instruments for hedging risk. They are risk transferring instruments. They are called derivatives because they derive their value from the value of some other asset. The other assets are called underlying assets. The most common underlying assets for derivative are stocks, bonds, commodities, currencies, interest rate, and market indexes. Okay, let's take an example of a wheat farmer. He expects to sell his produce, that is wheat, in 3 months' time. Okay, but he is uncertain about the price of wheat at the time of sale in future. Suppose the current market price of wheat is 30 per kg. We know that the future is uncertain, market price won't be the same, it's highly volatile, right? So the price of wheat may increase or decrease in future. If the price falls in future, he may incur a loss. Thus, he is exposed to risk due to price fluctuations. So to avoid this risk, the farmer enters into an agreement to sell wheat after 3 months at a price of rupees 30 per kg. So this agreement is an example of derivative. Okay. Suppose the wheat price falls to rupees 25 per kilogram after 3 months. Still, the wheat farmer will be able to sell the wheat at the price already agreed upon, that is rupees 30. Okay. Thus, he has eliminated the possibility of incurring a loss, that is rupees 5 per kg. He eliminated that loss. Okay, so he has protected himself from the risk through derivative. If he had not entered into the derivative contract, he would have been forced to sell the produce at a price of rupees 25 per kilogram. In that case, definitely he will incur a loss of rupees 5 per kg. Okay. Now, consider second scenario. Suppose the wheat price increases to rupees 34 per kilogram after 3 months. Now the farmer sells the produce at rupees 30 per kilogram. If he had not entered into the derivative contract, he would have been able to sell the produce at rupees 34 per kilogram. Okay. In this case, he would lose rupees 4 per kilogram. But he avoided the uncertainty of price. Okay, uncertainty of price change. Okay. Thus, derivatives are basically instruments used for eliminating the risk involved in buying, holding, and selling assets whose prices fluctuate. Here, the value of wheat derivative will be derived from the current price of wheat. Thus, the derivative derives its value from the performance of something else. That something else is the underlying asset. In the above example, the underlying asset is wheat. Okay, so this implies that derivative have no independent value of their own. Okay. Did you ever think what could be the factors driving the growth of this derivatives? Over the last 3 decades, the derivatives market has seen phenomenal growth. A large variety of derivative contract has been launched at exchanges across the world. Some of the factors are increased volatility in asset prices in financial market and increased integration of national financial markets with the international markets, improvement in communication facilities, and development of more sophisticated risk management tools These are some of the factors which led to the growth of derivatives. Now, benefits of using derivatives. What could be the benefits of using derivatives? Firstly, risk hedging. Of course, derivatives have to manage or reduce various business risk at low transaction cost. Secondly, reduction in financing cost. That is, the use of financial derivatives can help to reduce financing cost. Thirdly, better access to financial market. That is, financial derivatives products provides more access to financial market like mutual funds. Okay. Then asset management. That is, derivative instrument play an important role in asset management due to their lower transaction cost relative to the spot market instruments. And lastly, speculation. Financial derivatives can be used to speculate and make profits by taking risk. Okay. Next, participants in derivative market. First one, hedger. Secondly, speculator. Thirdly, arbitrager. Hedger, who is hedger? Hedger is the person who uses derivatives to hedge or prevent risk of loss in future. And speculator? Speculator is the person who uses to bet on future movement in the price of an asset. Speculators are those who are willing to take risk. They take risk to make profit from price fluctuations. Thus, their main objective or their main motive is to make money out of the risk assumed. Okay, so they accept risk in the expectation of a return. So they forecast the future economic conditions. Here is the difference between hedgers and speculators. Okay, the motive of hedgers is not to make profit but to reduce or eliminate risk. Next, arbitrager. He is the person who takes advantage of differences of prices between two markets. That is, he will take advantage from price discrepancies between two markets. Okay, you might be heard about arbitrage, right? Arbitrage process is the process of simultaneous purchase of securities in one market at a low price and sale of the same in another market at a relatively higher price. The traders who are engaged in arbitrage are known as arbitrageurs. Thus, these persons, that is arbitrageurs, purchase securities in one market where the price is low and sell them in another market where the price is comparatively higher. So, the motive or objective of arbitrager is to make profit from difference in prices of securities prevailing in the two markets. Now, types of derivative contracts. These are the major types of derivative contracts, that is forward, futures, options and swaps. These are other types of derivatives, that is warrants, leaves, baskets and swaptions.